Hello, my name is Patrick Hutzler, and I have prepared the Guide to Home Financing. What is the lender thinking for you? I'm a mortgage lender with over 25 years experience, and I want to share that knowledge with you. The first thing we want to take into consideration is the fact that the lender looks at 3 C's. We call it the 3 C's of lending and loan approval: credit, cash, and collateral. And I want to examine each one of those and explain to you what the lender thinks those are. Now, of course, everyone knows you need good credit to get a loan these days, but what is good credit? And where does it come from? And who determines it? There are 3 measurements. There's the Fair Isaac, Beacon, and Empirica. But to obtain the best credit score, what you really want to keep in mind is to minimize the number of cards you have and your credit accounts that you keep, and keep your balances to approximately 30 or maybe 50% of their maximum when you're ready to go find a new mortgage loan home, because it'll affect your score. And if you look at the chart here, the low end there is untouchable and poor. And if you get to the upper end and 800s and 900s, those are almost unattainable. And we'll look at what is good credit. What score is what the lender's looking for. Now, most importantly, with regard to credit, paying on time every time will get you the best available score. If you have rough credit, working with a professional service may help, but making a budget and sticking with it is a plan that works every time. So what's the big deal? The big deal is you save money. The higher your score is, the better rate you're going to get, and ultimately the lower total interest payment you're going to make towards this mortgage loan. Here's a comparison that shows a 30-year fixed rate loan of about $100,000 purchase price. Now, of course, most people are going to spend a little more than that for their home, but this, using $100,000, this is a good example to show you what, on even some of the smallest purchase, what you could save over the course of 30 years. This is a $10,000 difference. Now, of course, a $200,000 loan would be a $20,000 difference. Now I would recommend that you review this video a few times, and if you do, pause on that last section and just review it, and it'll help you understand where the math is coming from. But if you want to save money, getting your credit score as high as possible, that's the message there. It's going to happen. The next thing that the lender is going to look at is cash, and we'll break the cash down into two different things. There's money that you're making, that's your income, that's cash available to you every single month to pay your bills. But then there's a cash you accumulate and save. And we're not talking about the cash you invest. We're not talking about your long-term investments. This is the money we're talking about that you've left available to yourself for your purchase, the down payment towards your purchase. So when the lender's looking at this, the money has to be in the deal. They want to see that if someone's going to make a major purchase, that they have put some money away and they have some skin in the game. So what could I mean by that? Skin in the game. Well, the lenders are going to want to make sure that you actually have some money invested in this large purchase. This will be your home, and very often this will be the home that will be your home for a number of years. If it's your first home, you're going to definitely want to put something away over and above your minimum down payment, because you're going to have to put furnishings in that home. There's certain things you might want to do to improve that home. But for our purposes, the lender is just going to look at what you need to buy that house. There's going to be certain reserve requirements, especially in conventional, but FHA and conventional are going to have 3.5% for FHA, 5% for conventional of the sale price that is going to have to be in the bank and documented. And by documented, I mean it's going to have to be in an institution, a bank. It's going to have to be something that's not cash on hand or money that someone has lent you. We can talk about that in another segment. But this would have to be money that's in your account, an account that has your name on it. And it has to be 3.5% minimum for an FHA purchase of the sale price and available to you. The next part of the cash equation is going to be the income, the money you bring in every single month to help pay your bills, including your home. And lenders are thinking, if you can pay for something and if you can afford it and it's inside your budget and you're comfortable with it, you're going to be happy there. But they also realize you cannot be happy in a home or inside of a obligation that pretty soon starts sapping you of all of your income. You are no longer happy in that situation, and when that happens, it gets very hard to justify dedicating your income to it. And of course, that's when people end up in default or starting making late payments. They want to avoid that. They absolutely want to make sure you can make this payment. So they have devised a mathematical equation that helps them come up with it, and I'm going to share that with you. And when we look at this, this is a rule of thumb. We can be outside these debt ratios a little bit, but examine the percentages I have listed here, and I'll explain what they mean and how we use them to qualify and how we use them to identify a mortgage amount when we're trying to pre-qualify someone. I've put an example here together, and again, there are very few markets left where you can purchase a home for $100,000 or less, but frankly, there are some properties that are worth more than $100,000 and you can buy them for less. Foreclosures, Fannie Mae owned inventory properties, all of these, I'm going to have a whole segment on just purchasing Fannie Mae inventory owned properties and what Fannie Mae will do for you. But for this example, we're going to look at what someone just curtailing their auto purchases can do. I would suggest you pause and read this clip, and you can see just changing your automobile structure, the monthly payment to your automobile being $200 versus $400. Look at the advantage to your purchase power. It has gone up $30,000. So look at this math and see if you can see why that might happen. But this is absolutely what the lenders would be looking at. I'd recommend, if you didn't quite understand that last slide, rewind, go back, look at it again. But what that really means is if you limit your monthly payments to things like automobile, credit cards, if you keep those down to the bare minimum until you purchase your home, or if you get them down, pay off an automobile somehow, or get it below 10 payments so it's not counted against you, you're going to increase your buying power. The next page here, we're looking at what happens if the seller pays your closing costs. And once again, I would just invite you to pause and look at the math here. It'll save you some time if you go past this and try to rewind to find it. But this is an example of the seller paying closing costs and what it ends up doing in terms of the money you bring to a closing. And in a nutshell, this is simply, if the seller pays the closing costs, it's going to save you out of your bank account dollar for dollar every dollar that the seller is willing to pay, because you are borrowing in many cases 96.5% of the sales price. So as you can see, if you give them a little more, instead of giving them $100,000, if you can knock them down to 100, well, it's more likely that they'll take the 103, pay the $3,000 in your closing costs. Now your monthly payment will go up about $15 a month in this example. But it is well worth it, because look at the money you save. $3,600 versus $6,500. And the next thing, the next C that we're going to look at is collateral. Collateral is what the lender is going to want you to put up for the loan. In other words, they're not going to lend just on your signature. They're going to require that if for some reason you can't pay, there's something that you can sell, and upon that sale the loan can be paid. And of course, we've heard the horror stories where people couldn't sell their home or chose not to and walked away from them, and the lender has to take that house and sell it and pay the loan off. And that's what we call the collateral, the home. And now there are certain homes that have not done very well in terms of resale for purchasers or lenders, and I've listed them here for you. Condos, manufactured homes, not all manufactured, but most manufactured homes. But I have simplified for you what the lender's thinking. You have to love it. You have to love that house. You have to want to be able to live there and be happy there, and you're going to go into contract and put your savings against it and make monthly payments on it. The lender just has to like it. The lender just has to realize that it's a deal that makes sense. And what they're thinking is, if we have to, could we, the lender, sell it? And sell it for what they have in it. Now, they're going to have third-party appraisal come in. They're going to do everything they can to make sure that you and they are making a good decision. But when it comes right down to it, they have to be sure that what you're paying for that home is the true market value. That's for your protection and for theirs. Now, remember earlier I mentioned that there might be homes that you could purchase below market value, inventory homes at Fannie Mae, things like that. And a lot of people are under the misunderstanding, I guess, or the illusion that if they get a deal like that, that their new lender is going to use the value, regardless of what they offer for sale price, based on appraised value. And that's just not the case. The lender will always use the lower of appraised value or sales price. That's what they're going to lend on. If you bought a home that was worth $200,000 and you paid $100 for it, if you paid $100 for it on your sales contract, it's worth $100,000. And again, pause this screen and look at the math here so you can see what I'm talking about. I like to point out there was an example on that previous cell that showed the appraised value coming in low. I will do an entire segment just based on what to do when your appraised value comes in low. The most obvious option, which is not the best option, but the most obvious, is that this buyer might have to bring that difference to close. That is not always the right way to go. But we have 3 C's in our loan approval. Credit is the key. Get that credit rating as high as possible. It saves you money. Cash. You need a job. Obviously, you have to have money every month. You got to pay the bills. And you have to save some money too. There are programs, and I will talk about those. There's VA programs. There's what we call USDARD, Rural Development Home Loans. All those are 100% financing. But most of the 100% are gone. Collateral, you have to be pre-qualified so the realtors know what to even look for. If you are out there finding homes that you can't afford, then you aren't doing yourself or your realtor any good at all. You're actually wasting your time. Get with a qualified loan officer. Get pre-qualified. That will be as good as money in the bank for you. You're going to save a lot of time. So we've discovered that getting that credit score up is going to get you the best interest rate available. And over the course of your loan, that's going to save you money. Even a $100,000 loan is going to save over $10,000 over the course of just the 30-year mortgage. So we've also examined hunting for that home is going to be a lot less stressful if you know what your income and what your down payment is going to produce in terms of purchase price. That's going to help the realtor as well. You're going to hunt for a house and know what you can afford and know what that monthly payment's going to be, and that you have the money in the bank to pay for it. We've also examined how important it is to make sure that that house that you want is worth what you are going to pay for it. The lender needs to know this. You need to know it. If there is any reason that you need to sell that house, you need to know, and so does the lender, needs to know that the market value was supported the day you bought it and is likely to be supported the day you need to sell it. So in closing, I would just like to remind you that you have the power. We can measure your credit, your cash, your collateral, your income. We report that back to you, but these are the parameters we use. You have the power to improve your credit. You have the power to put more money in the bank. And when you're shopping for that home, you have the power to maintain that budget and shop within your means so that when you purchase your home, you're buying a house that you're going to remain happy with. Good luck with your home search, and you can always visit us at patcatconstruction.com and watch for more information on how to purchase homes, save money, improve your credit, and we'll have a segment on investment purchases as well. Thank you. I would also like to ask you to please share this information with your friends. Go ahead and send this over to anyone that you can think of, any email account, anyone on your Facebook. Send it to yourself on Facebook. If you save it there, you can revisit this very easily. Thank you.